Are we on the brink of a stock market crash? Experts reveal 8 warning signs and what you can do now. The whispers are growing louder. A stock market crash is looming. While experts agree on the inevitability, pinpointing the exact moment is a fool's errand. Global tensions, from the Trump administration's uncertainties to the Middle East volatility, coupled with record-high stock markets and AI company valuations, paint a picture of potential turmoil. But here's where it gets controversial. Could we be overlooking a crucial indicator? And this is the part most people miss. Understanding these warning signs could be the difference between safeguarding your investments and facing significant losses. 1. The yield curve. A telltale sign of trouble? Imagine a graph plotting bond interest rates against their maturity periods. Normally, longer-term bonds offer higher yields due to increased risk. However, when the yield curve inverts, meaning short-term bonds pay more than long-term ones, it's a red flag. Historically, this inversion has preceded recessions, signaling central banks likely interest rate cuts to stimulate growth. For instance, every time 30-year U.S. bonds have paid 1 percentage point more than 5-year bonds over the past 50 years, a recession has followed. While the UK yield curve remains normal, investors should monitor it closely. 2. Employment rates, the canary in the coal mine. Rising unemployment often signals a bursting bubble and economic recession. In September, the UK saw a 25,800 increase in jobless claims, though pandemic-skewed data complicates the picture. A stagnant jobs market in the UK and US warrants caution, as it reflects reduced consumer demand and labor market stress. 3. PMIs, the pulse of economic activity. Purchasing Managers' Indexes, PMIs, offer a monthly snapshot of economic health across industries. A score above 50 indicates expansion, while below 50 suggests contraction. The UK's composite PMI dropped to 50.1 in September, and its manufacturing PMI hit a 5-month low of 46.2, marking 12 consecutive months of decline. These figures, while not as dire as during the pandemic, highlight businesses grappling with rising costs and economic uncertainty. 4. Economic Surprise Index. Are we overly optimistic? This index measures the gap between economic forecasts and actual results. A persistent negative surprise can signal a shift in sentiment and growth outlook. While the global index has improved to 8.2 from -5.4 a year ago, investors should remain vigilant for sudden shifts that could indicate an impending downturn. 5. Government deficits, a ticking time bomb? When government spending exceeds tax revenue, deficits rise, often funded by borrowing. The UK's deficit reached 5.3% of GDP in the year to April, up 17.2% from the previous year. If left unchecked, this could increase borrowing costs and stifle economic growth, especially if interest rates remain high. 6. Government debt cost. The speed of the rise matters. The UK's 10-year gilt yield, currently around 4.38%, indicates the cost of servicing government debt. While the yield itself is important, the speed of its increase is more alarming. For example, the rapid rise in 2022 after the Liz Truss mini-budget sparked widespread panic, whereas a gradual increase allows investors to adjust. 7. Company results. The writing on the wall? Earnings downgrades, missed forecasts, and dividend cuts can signal weakening corporate health. During the 2020 pandemic, at least 47 FTSE 100 firms reduced or suspended dividends. While payouts remain relatively stable now, investors should watch for simultaneous cuts across sectors, which could foreshadow a broader sell-off. 8. Investor sentiment. The bubble and the burst. Bullish investors drive asset prices up, but when optimism outpaces reality, bubbles form. Conversely, bearish sentiment can trigger panic selling, leading to crashes. Metrics like the P/E ratio and the volatility index, VIX, can help gauge sentiment. For instance, the VIX above 25 to 30 often precedes market dips. Currently at 17, it's worth monitoring for sudden spikes. The bottom line: stay informed, stay prepared. While no single indicator guarantees a crash, collectively they offer valuable insights. The question remains: are we paying enough attention to these warning signs? And more importantly, what actions are you taking to protect your investments? Share your thoughts in the comments. Do you think a crash is imminent, or are these just temporary jitters?